The information provided in this program is of a general nature and is not intended to be personalised financial advice. We encourage you to seek appropriate advice from a qualified professional to suit your individual circumstances. Hey, Paddy, thanks so much for joining us on this one. Really appreciate it.
Good to be here, Madison. Thank you for inviting me.
Look, I want to ask you about the 10-year average return for all of these asset classes. Let's start with the winners. Top 5, who came out on top?
Over a 10-year period, it's going to be global private equity. So the private equity returns returned 16.4% on average over 10 years. And for investors who could benefit from that illiquidity, they did extremely well.
Can you explain to me how an investor could invest in private equity? I'm assuming these are listed companies like Berkshire Hathaway and those sorts of things.
That's it's one way of doing it. A lot of investors, institutional investors in particular, will go into closed-ended private equity funds. So there's a very large universe out there. It's increasingly becoming a big part of the institutional investment universe. And when I talk about institutional investors, I'm talking about the largest investors so some of the large KiwiSaver funds, but also globally, some of the big pension funds globally. I think New Zealand Super in New Zealand. They did have relationships with some large private equity groups globally, and these look to take advantage of an illiquidity premium. So, for example, taking private companies, which might be trading at significant discounts on the equity market, and nurturing those companies back into shape again and receiving very strong returns for doing so. Also taking advantage of a lot of thematics in the market. So at the moment, you've got things like the significant increase in the use of data around the world, the energy transition and the increase in sustainable investment. And a lot of these private equity investments are very well catered towards focusing on those thematics.
Does that suggest to you that if an investor is in it for the long haul and can afford to be in a less liquid long haul asset like PE, that they'll make more money off it?
Yeah, and I think it's that's true at a high level, absolutely, Madison. But I think you really need to focus on diversification. And I think this periodic table really just shows you can't really pick winners in markets for a sustained period of time. So diversification, not having your eggs in one basket, is absolutely important, and that comes through with PE as well. It's not just investing in one PE fund; it's investing in a basket of PE funds over a number of different vintages, to get out ahead and get those strong returns.
Runner-up was New Zealand Equities. Why are we doing so well?
Yeah, this is a bit of a anomaly, really. So the New Zealand equity market has performed extremely strongly over 10 years, so 12.1% on average over 12 years. Not so good over the last couple of years, Madison. And I think the number of reasons for that. The New Zealand equity market is very small. We've got to remember that this Australian population is 5 times our population, but their equity market is 20 times the value, and the New Zealand total value of the New Zealand equity market is not even as much as the value of the largest Australian company in their market, and it's about a 20th the size of Apple, the largest company globally. New Zealand market has done extremely well. We have a lot of domestic KiwiSaver capital in New Zealand, which does have a home bias. The New Zealand equity market also historically had a high distribution yield, so that's the value of the dividends. And in a lowering interest rate market, so with the Reserve Bank lowering the OCR over the past 10 years from 2.5% in 2013 down to 0.25% in 2020, that distribution yield or that dividend yield was seen as like a good income proxy for investors. So a lot of investors piled into high-yielding New Zealand stocks. It's also very dominated by 1 or 2 companies. So at any point in time, the top 2 companies are roughly about 25% of the index. And you remember 2016 to 2020, A2 Milk did extremely well. That really pushed up the performance of the New Zealand index. It was one of the top performing stocks globally. And then 2020, Fisher & Paykel Healthcare really came into its own in the COVID pandemic and performed extremely strongly and pushed up the value of the NZX. More recently, as interest rates have started to rise, that's just been a headwind to the NZX being a interest rate sensitive stock market.
So those top assets then, private equity at the top, NZ Equities runner-up, and then global equities certainly in the mix with 10-year average returns of almost 11% for most of them there. Are those here to stay, or do you expect that to change in the next decade?
Yeah, I think what you'll generally see is that the top end of returns are going to be dominated by your growth assets. So this is for investors who can take risk. They'll be investing into they'll be able to, if you're investing for the long term, as you should be with your KiwiSaver fund over multiple decades, you should be in a position to take risk with your portfolio if you're relatively young and not close to retirement age. So those investors who are focusing on those high risk asset classes, I think what you've really got to focus on is that the time in the market beats timing the market, that old adage. So forget about the near term volatility and trying to pick peaks and troughs. But if you're invested in growth assets over the long term, you'll generally do pretty well. If you're invested in cash and low risk government bonds, you will on average perform significantly worse than those investors who've invested into growth assets.
Yeah, on that, let's talk about the losers. Commodities, a negative 10-year average return. Why are they doing so badly?
Yeah, I think if you've got to look at the breakdown of that commodity index, and a lot of that index is energy. So 30% of the index is energy, and that has been, oil prices have been falling significantly over 10 years until very recently. And that's why you'll see commodities being the top performer in 2022 off the back of the Russian invasion of Ukraine and the real energy squeeze that we saw there. Grains are also a large part of the commodities index, and again with Russia's invasion of Ukraine, both countries are large grain exporters and fertilizer producers, and that's really seen an increase in the prices of those soft commodities. But I think really commodities are largely linked with precious metals and being gold and silver. And as the economy has been running very strongly in the early parts of the last decade, people were moving away from those safe havens of gold and silver and focusing on more of those growth stocks and the tech stocks in particular, which performed very, very strongly.
But investors heavily moved their funds into things like government bonds, into things like debt, cash, certainly as well. So is this of concern to you then, the fact that your numbers show that these are barely even going to make investors a return in 10 years?
Yeah, and I think investors really need to look at a diversified portfolio. So if you're looking at KiwiSaver returns, for example, that the average balance fund has returned 6.5% over 10 years. But if you move up to a growth option, which is more in line with a younger demographic and having multiple years before retirement, your return would have lifted up to 8.1%. And those investors, those KiwiSaver funds, do invest in a balance of growth stocks and defensive stocks like cash and government bonds. So it really does provide that barbell approach. And generally, bonds will actually perform very well when equity markets sell off. We didn't see that in 2022. So there was actually a correlation. Both asset classes performed badly in 2022. But generally, those bonds will actually bolster your portfolio and smoothen out your return journey when equity markets are more volatile.
Well, history shows us that equities are certainly the place to be, right, Paddy?
I think of long-term medicine, absolutely. And diversification is absolutely important. Making sure that you're not exposed to one single market, one single geography, one single stock. So there are significant binary risks for those investors who don't diversify. But for those who are looking to have a very long-term, strong performing portfolio, you need to invest very strongly. And for those who can have a bias to growth assets such as equity, private equity, which have proven to be very strong performers over the years.
Thanks so much, Paddy, and thanks so much for this data from Mercer. It's pretty cool to see.
Pleasure, Madison. Great to chat.
Thanks for watching Markets with Madison, the New Zealand Herald's show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.